Ladies and gentlemen, good day and welcome to the Raymond Limited Q2 FY23 conference call hosted by Antique Stock Broking Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhijit Kundu. Thank you and over to you.
Yeah, thanks. On behalf of Antique Stock Broking, I would like to welcome all the participants in the Q2 FY23 conference call of Raymond Limited. I have with me Mr. J. Mukund, who is the Head of Investor Relations of Raymond Limited. Without taking further time, I would like to hand over the call to Mr. Mukund. Over to you, Mukund.
Thank you, Abhijit. Good evening, everyone, and thank you for joining us for our Q2 FY23 earnings call of Raymond. I hope you would have received a copy of our results presentation. I would like to urge you to go through this along with the disclaimer slides. Today we have with us from the senior management of Raymond, Mr. S.L. Pokhanda, who is Director of Raymond Limited, Mr. Amit Agarwal, Group CFO, Mr. Sunil Kataria, CEO of Lifestyle Business, Mr. Harmohan Sahni, CEO of Realty Business, and Mr. Jatin Khanna, Head of Corporate Development. Now I would like to hand over the call to our Group CFO, Amit, who will give you the summary of the company's quarterly performance before we open up for Q&A. Over to you, Amit.
Thank you, Mukund. Good evening, ladies and gentlemen. Thank you for joining us today for the earnings call to discuss our results of second quarter for the fiscal 2023. First of all, I would like to wish you all a very happy Diwali and a new year. I hope that all of you had a wonderful festive season with your near and dear ones. It has been a much-awaited occasion for all of us in India, and the festivities have ushered in a spirit of optimism and hope. Let me now start with giving you a brief overview of the second quarter of the current fiscal. It has been a strong quarter that has seen encouraging demand with life returning to normalcy. Majority of physical offices have resumed, and work from home has now more or less taken a backseat. We have also seen an increasing number of social gatherings owing to festivals and travel and tourism bouncing back with vigor. All these factors have been good contributors in maintaining a healthy momentum in consumer sentiments that witnessed consumers being on a spending spree. As far as apparel segment is concerned, the end of season sale extended till mid of August, and we witnessed lower discounting by brands in the market. In addition to the surge in shopping for festivals, we also saw an uptake in our new product offerings in terms of design and functionality. We have been consistent about delighting our consumers with freshness in collections across our store network. Now let us delve into the second quarter of fiscal 23 performance. Raymond Group has embarked upon a journey of enhancing profitable growth and has maintained the momentum on a quarter-to-quarter basis across businesses by capitalizing on existing offerings along with a new range of products and services. Our sustained focus on cost and working capital optimization has reaped results in improving our performance across businesses. We are happy to share that our second quarter of fiscal 23 has recorded the highest ever quarterly revenue and EBITDA. This quarter performance is the fourth consecutive quarter of record performance. Our consolidated revenues have grown by 38% to 2,191 crores from 1,583 crores in the second quarter of fiscal 2022. Driven by strong demand across all businesses in both domestic and export markets. I am delighted to share that we have clocked highest ever revenue and have achieved highest quarter 2 EBITDA of 358 crores with an EBITDA margin of 16.3% in the last 10 years. It is heartening to share that we have a profit after tax of 159 crores, which is a growth of 198% as compared to 53 crores in second quarter of last year. Also, as compared to pre-pandemic levels of same quarter, we have delivered profitable growth across segments with the revenues in second quarter of fiscal 23 higher by 15% versus 1913 crores in second quarter of fiscal 20, and an EBITDA margin at 16.3% in second quarter fiscal 23 was higher by about 390 basis points versus 12.4% in second quarter of fiscal 20. Our second quarter reported profit after tax of 159 crores is 89% higher as compared to 84 crores in second quarter of fiscal 20. Now let us go through our segment-wise performance for the quarter. Branded textile segment maintained quarter-on-quarter strong performance with a top line of 912 crores and a robust EBITDA margin of 22.3%. The top line grew by 26% as compared to previous year same quarter sales of 722 crores. The revenue performance was driven by a strong demand for premium product categories across suiting and shirting fabrics. The trade channel sales grew at the backdrop of strong bookings driven by product innovations that were well received by our trade partners. In addition to the strong festive demand, there was sustained demand for the office wear and encouraging response to our casual wear categories by the customers. In the suitings business, reopening of offices led to a resurgence in demand for wool-rich blends and premium polyviscose categories that is an apt choice for suits and trousers. In addition to the exotic and exclusive collections, the newly launched stretchable and sustainable collections including Spanex, Supernova and Techno Series, Techno Stretch receiving a promising response from customers across. Our social initiative, Garment Exchange Program, in association with Kunj, which was executed across our 1,000 plus strong TRS network, the Raymond Shop network, has received great response as about 3 lakhs pre-owned garments were given to the lesser privileged sections of society under the Clothes for Work program. Now let me talk about our B2C shirting business. New seasonal collections imbibing latest designs and comfort, which is offered by premium quality cotton and linen, drove higher realizations and better product mix. As India went on a shopping spree, our 1,000 plus TRS network stores spread across 600 cities reported 26% growth in average transaction value as compared to pre-pandemic second quarter fiscal 20 levels. The increasing disposable income and the exposure to newer fashion trends have resulted in consumers widening their wardrobe choices that are suited for different occasions beyond work. The segment reported a robust EBITDA margin of 22.3% driven by diversified product mix in suiting as well as shirting fabrics and enhanced operational efficiencies. Now let me talk about the branded apparel segment, which showed a very strong sales growth of 67% to 370 crores as compared to 221 crores during second quarter of previous year. As mentioned earlier, the resumption of normalcy along with the launch of our products imbibing new design aesthetics in line with global fashion trends are resonating well with consumers as they are seeking freshness in their wardrobes. Our performance was driven across all brands of Park Avenue, Color Plus, Raymond Ready to Wear and Park, which offers a plethora of options for consumers to dress up across occasions. We have been optimistic about the ethnic wear as a segment given the increasing demand for the category as an occasion wear, and we have launched collections wide ranging from same ethnics, smart ethnics to wedding wear and expanding our presence in the segment through Ethnics by Raymond. The performance was driven across our retail network of EBOs and the TRS shops. During the first half of the year, we have opened 21 EBOs on a net basis. Currently, our EBO network is performing well and as we have received an overwhelming response from our customers for our new collection in core product portfolio and casual category. There are plans underway to make a strong foray into the ethnic wear segment through our brand Ethnics by Raymond, and till date we have got an overall 35 stores. The segment reported an EBITDA margin of 9.7% as compared to 3.4% in the same quarter previous year, driven by continued operational efficiencies. Now let me talk about the retail network. During the first half of the year, we have further strengthened our retail footprint with net addition of 25 stores across metros, tier 1 to 4 towns, making a total count to 1,376 stores spread across 600 towns as on 30th September 2022, from 1,351 stores as on 31st of March 2022. Amidst the backdrop of strong consumer sentiment, we witnessed strong traction in secondary sales with significant improvement in average transaction value. As mentioned earlier, the TRS network reported a 26% growth in average transaction value as compared to pre-pandemic levels respectively. Now let us talk about the garmenting segment, which reported a strong growth of 25% to 266 crores compared to 212 crores in the previous year due to higher demand from our existing and newly acquired global customers. With the key export markets of US, Europe and Japan continue to grapple with inflation and supply chain issues, however, with continued adoption of hybrid work culture, there has been a growing consumer demand for office wear, and we have been increasing the bulk business and tailored clothing for customers. Given our strong capability in the manufacturing fabric as well as garments, increasingly we have acquired new customers on account of vendor consolidation along with the China Plus One strategy adopted by leading global brands who prefer integrated suppliers to be their co-partners. The EBITDA for the garmenting business in the quarter was 23 crores with an EBITDA margin of 8.7%, while it was 22 crores of EBITDA in the previous year. The EBITDA was impacted due to increase in the order intake as we are adding workforce to cater to the increased demand, and we are supplying to high-end global retailers. Adequate training is to be imparted to the employees in order to ensure high-quality product delivery, which resulted in increase in the employee cost. Let me talk about the high-value cotton shirting segment, where the sales grew by 42% to 211 crores compared to 148 crores in the previous year due to higher cotton fabric sales in the domestic market along with a demand tailwind from B2B customers. The segment reported an EBITDA margin of 13.2% for the quarter as compared to 17.4% in the previous year, lower mainly as the inventory consumed for production was at a higher cotton prices, and as we know, the ability to we have been able to pass on the increase in cotton prices to our customers with a time lag. Now let us have a look at the performance of the engineering business, which was consolidated under JK Pipes and Engineering Limited in the quarter 3 last year on an aggregate basis. Sales grew by 4% to 228 crores as compared to 219 crores in the previous year. In the domestic market, the demand momentum across sectors was maintained for most of our product categories. Ring gears, drills, hand tools and power tools continue to perform well. In the export market, with inflationary environment and depreciation of euro currency, our B2B customers have deferred certain orders as they are witnessing a slowdown in the secondary demand. On an aggregate basis, the business reported lower EBITDA margin of 12.8% as compared to 15.5% in the previous year. The margin was lower mainly due to higher steel prices, continued higher freight costs, and depreciation in the euro, which was partly offset by the higher productivity and efficiency measures. Coming to our newest business, which is in the real estate segment, has been scaling greater heights of success, and I am delighted to share that for the second consecutive quarter, we have been rated number 1 in Thane market, with the projects being number 1 and number 2 in terms of value of units sold in the region. This rating has been done by CRE Matrix, a leading real estate research platform. Our premium quality offering in 1 and 2 BHK projects of 10x and premium 3 and 4 BHK projects of Address by GS, which is backed by fast-paced construction activity, has been well appreciated by the customers. We are on time to deliver homes in the first towers 2 years ahead of FRERA timelines, and numerous first-time homeowners will get the keys to their dream homes in December 2022. The sales grew 3 times to 247 crores from an 81 crores in the previous year, and the EBITDA margin stood at 25.6% as compared to 20.6% in the previous year. The top line growth was mainly due to higher number of bookings in both the projects, with construction momentum being maintained. As well, our first project 10x received 120 bookings in the current quarter, higher than 107 bookings received in the same quarter of the previous year. In total of 2,186 units have been booked as on 30th of September 2022, which accounts for approximately 85% of the total inventory launched, with a booking value of over 2,200 crores. Our new premium residential project by the name The Address by GS, which was launched in third quarter of fiscal 2022, continued to receive great response from customers, with 68 bookings during the second quarter. The total bookings made for this project accounts for 349 units, which is once again 85% of the total inventory launched, with a booking value of 834 crores. It gives me an immense pleasure to state that within 11 months of the project launch, about 64% of the total inventory has been sold. As far as construction is concerned, our fast-paced construction activity continued in all 10 towers of the 10x project, as well as on the 2 towers of the Address by GS project. Let me talk about the pace of the construction. In the 10x project, the tower-wise construction status is as follows. The lift installation, electric fittings, entrance lobby work in progress for the first tower 1 and 2 and 3. In tower 4, internal finishing works are in progress. Terrace slab is completed. Above terrace works are in progress for tower 5, 6 and 7. And 41st slab work is in progress for tower 8. 11th slab work is in progress for tower 9, and 9th slab work is in progress for tower 10. As far as our second project, the Address by GS is concerned, columns above podium 3, slab and concreting work is in progress for tower A, and columns above podium, first slab and concreting work is in progress for tower B. Now let me discuss on the operating cost, working capital and the cash flows. As far as operating cost is concerned, our OPEX to sales ratio is lower at 24.6% as compared to 26.8% in the same quarter last year, and 30.4% of pre-COVID levels of second quarter fiscal 20. On an absolute basis, while our revenues have increased by 38% to 2,191 crores, our OPEX cost increased by 27% to 540 crores as compared to previous year same quarter. Also, as compared to the pre-COVID levels, while revenues have increased by 15% on absolute basis, however, OPEX cost has decreased by 7.2% to 540 crores in second quarter fiscal 23 as compared to 582 crores in second quarter fiscal 20. At Raymond, we continue to stay focused on cost and numerous initiatives undertaken that have been instrumental in achieving desired cost efficiencies, which we have regularly highlighted over the last 2 years. And however, with a sustained focus to drive growth and building a strong brand equity for the future, we are investing in advertisement and sales and promotion expense. As far as the working capital is concerned, with our continued focus on efficient working capital management, during the quarter we have been able to reduce the net working capital to 62 days, which is lower by 7 days on a quarter-on-quarter basis from 69 days in June 2022 and by 11 days on a year-on-year basis from 73 days in September 2021. To cater to the strong festive and winter wedding season in second half of this year, we deployed working capital primarily in production and sales, which resulted in increase in inventory and receivables. Hence, on an absolute terms as compared to June 2022, the net working capital is higher by 169 crores to 1492 crores in September 2022 versus 1323 crores in June 2022. From a cash flow perspective, at the backdrop of strong profitability, we generated operating cash flows of 119 crores and free cash flows for the quarter is 35 crores. The cash flows generated from the operating businesses were partly utilized for funding of the working capital, and the free cash flows was utilized for debt reduction. As far as net debt is concerned, the gross debt stood marginally higher at 2,096 crore as on September 30, 2022 as compared to 2,049 crore as on 30th of June 2022. We continue to maintain strong liquidity levels with cash and cash equivalent at 810 crores as compared to 739 crores as on 30th of June 2022. The cash and cash equivalents is a combination of cash and bank balances, short-term investment, and certain long-term investments whose maturity is the long-term, however, which can be liquidated on a short notice. Overall, our net debt reduced by 24 crores and it stood at 1,286 crores as on September 30th, 2022 as compared to 1,310 crores as on 30th of June 2022. In an increasing interest rate scenario, we have been able to reduce the average interest cost borrowing cost to 7.65% in second quarter as compared to 7.79 in the first quarter, led by change in borrowing mix. There is a marginal increase in the interest cost in the second quarter at 63 crore, which is higher by 4 crore on year-on-year basis, which is mainly due to higher utilization of working capital facilities during the quarter. Overall, our net debt to equity ratio has marginally improved.
The operator here?
Hello?
This is the operator here?
Yeah, I think there is some drop at Thane.
Yes, we are reconnecting the management.
नॉर्मल स्पीड में नहीं होता
Ladies and gentlemen, we have the management back connected.
Yeah, sorry for this. There was some issue with the connection. We are back. So overall, our net debt to equity ratio has marginally increased from 0.45x in March 2022 to 0.48x in September 22, which is also at a comfortable level. Now let me talk about the current status of operations and the near-term outlook. The October month was full of festivities and we have witnessed greater demand for our products and services in this period. Also, we have witnessed improvement in average transaction values in our retail stores. Also, we received good bookings by the trade partners for the winter wedding season. With the upcoming winter wedding season starting from mid of November, we expect the momentum to continue in both branded textile and branded apparel segments, while at the same time we are closely monitoring the impact of demand in the current inflationary environment. With regard to store expansion, we are in line to have 70 stores in the current year across India, driven by Ethnics by Raymond store expansion to cater to the fast-growing ethnic wear market. In the garmenting segment, export levers continue to be helping us with China Plus One strategy and the global retail industry undergoing a consolidation phase. We have order book in place for the next 2 quarters. From a raw material perspective, the wool and the polyviscose prices have remained stable. Over the last couple of years, the cotton prices have increased significantly. However, recently the prices have stabilized but remain at a higher level as compared to pre-pandemic levels. However, we have been able to largely pass it on to our customers with a bit of a time lag. In the engineering business, we are witnessing the domestic retail demand in consumer sector remain healthy, and we expect the same to continue. In the export market, where we cater to multiple sectors across geographies with inflationary trends in economies of European countries and US, we are working closely with our customers in assessing the demand and catering to the requirements. From raw material cost perspective, the steel prices have been on an inflationary trend and for the last 1.5 years have recently softened. Also, we have the ability to pass on the same even though with a time lag. However, the freight rate continues to remain the core area for monitoring as there is a shortage of containers which is resulting in delay of shipment as well as higher freight costs. In the real estate market, we expect the growth momentum in residential markets to continue. The construction activities are in full swing in both of our projects and we stay on course to start delivering flats in 10x projects ahead of RERA timeline by nearly 24 months. The recent interest rate hike by RBI, 1% metro cess imposed by central government, an increase in GST rate on works contracts from 12% to 18%, an increase in input prices for the real estate are being closely monitored. From a net working capital perspective, over the last 2 years, we have optimized the net working capital in terms of number of days, and we would aspire to maintain those levels on an annualized basis. Overall, we would like to state that our debt guidance of being a net debt-free company within the next 3 years stays on course. The net debt is expected to be substantially reduced through a combination of free cash flows generated from our business and proceeds from corporate actions such as our engineering IPO. At Raymond, we are committed to create an organization that upholds our value of trust, excellence, and quality in all what we do. We value your support and look forward to being together with each one of you in this journey. Thank you very much. Now we are open for questions.
Thank you. We will now begin the question and answer session. Participants who wish to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question on the line of Darshil Zaveri from Crown Capital. Please go ahead.
Hello, good evening team and congratulations on once again amazing set of numbers. So I just wanted to understand that since that now we've been growing quarter on quarter and been doing so well, so we're doing better than pre-COVID. So what kind of base do we assume right now that will be sustainable in terms of revenue and margins? Should quarter 2 be taken as the base for our future growth, or due to some seasonality, quarter 2 and quarter 3 would be better? So just some explanation regarding that.
Yeah, no, actually, thank you first of all. Look, the business has a seasonality. There's no doubt about it. We will have the wedding season, festive seasons, which would be as a peak, so to speak. And we all, since we sell primary to our dealer network, franchisee network, Q2 seems to have a very big push. But also we know, as I talk to you, that in the Q4 we have large number of marriage dates. Almost 48 marriage dates are there in the Q4. So we see a good momentum for our business. And I think our focus is clearly we have built a strong base and grow the base from here.
If I could summarize, we feel that quarter 3 and 4 could be better than quarter 2, and quarter 2 could be a decent base for us in terms of our margins as well as revenue, right?
No, actually, as I said, quarter 2 we have shipped out, so we have invoiced for meeting the demands for the customers to our dealer network in the quarter 3. So quarter 2 is already at a higher level because that has picked up all the benefits of the festive season.
Okay. So, okay, thank you. That helps also a lot. So could you just help out and maybe what are our plans for next year, or maybe some kind of guidance for FY25, or what are some short-term time of growth in terms of revenue and margins? That would be very helpful.
Yeah, see, at this juncture we are not giving really a guidance in terms of this revenue and profitability.
Okay, yeah, thank you. That answers most of my questions, and congrats on a great job. Looking forward to hearing the next call. Thank you.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on your touch-tone telephone. Participants who wish to ask a question may press star and 1 on your touch-tone telephone. We have the next question from the line of Priyanka Trivedi from Antique Stock Broking. Please go ahead.
Yeah, thank you for the opportunity. My first question is on the branded apparels business. Could you give us a sense on what would be for the existing stores the like-to-like growth over 2Q FY20 levels?
Yeah, I'll ask Sunil to respond, please.
Yeah, so hi, this is Sunil here. So I'll give you a broad estimate. So I think our like-to-like growth stores, because we had also done a reduction in number of stores during COVID, a rationalization. So our like-to-like store growth right now or pre-COVID is a decent, healthy double-digit growth right now that we're seeing.
Okay. And in terms of the margins, the margins that we've delivered this quarter of almost 9%, do you think that would continue in the coming quarters?
Yeah, I think the focus on delivering margins is very clear. We have done a very strong cost rationalization exercise over the last year itself. I think the clear 2 areas of focus in the branded apparel business for us will be that now, we are ramping up our product portfolio. So I think that will be one very big area that you will see us doing. In fact, one theme which I want to put further forward would be that we will see going forward from next quarter 2 onwards to the next year is a casualization theme, because that's a very big opportunity. So product portfolio expansion is happening. Secondly, you may have already seen right now a lot of brand investments have started happening after a gap now. So that's the second area which we're doing. And third, as Amit has also mentioned, we are looking at store expansion. But while doing all this, we expect to make sure that we have healthy EBITDA margins. We want to hold that.
Yeah, and just to add, you see, the best part is the operating leverage. And if you see across our businesses that the operating leverage has improved our margins. As we talked about pre-COVID, our OPEX cost used to be at 30%, and now we have been able to bring it down to 24.6%. So to that extent, that is truly the benefit which we are going to see in improving the margins.
Okay, got it. And just on the casualization theme that you mentioned, what would be the share of casuals right now, and what are we targeting it towards?
So, okay, I would not be able to give you an exact number because if you see, 2 of our brands itself are currently casual. So within our 4%, so that's not the right way to look at it. The way you look at it, we have 4 portfolio of brands between Raymond, Park Avenue, Color Plus, and Parks, out of which Parks and Color Plus are 100% casual brands. And the 2 brands which are Raymond and Park Avenue are more skewed towards formals. So the theme which I see is, what I'm saying is that even within the brands like Raymond and Park Avenue, we see a foray into casualization which will start happening. While 2 of our brands in any case are casual brands.
Oh, got it. Got it. Thank you. And last question is on the real estate business. So just wanted to understand the project revenue and the cash flows that we are targeting from the Address by GS project over the span of next 3 to 4 years.
So look, between these two projects, we are targeting very clearly a revenue to the tune of 4,200 to 4,300 crores, and we expect a free cash flow generation to the tune of 1,200 crores between these two projects.
Okay, got it. Thank you, sir. That's it from me.
Thank you. We have the next question from the line of Ritesh Bajatia from Asian Market Securities. Please go ahead.
Yeah, hi. Thanks, sir. Firstly, congratulations on the good set of the numbers. So I have a couple of questions. First one is on the garmenting margins. This quarter we have report about 7.5 or 7.3% kind of the margins. So just wanted to understand, it is just one quarter phenomena or is it a normalized margins also going ahead?
Yeah, maybe I think you tell all your questions and then we can respond to the questions.
Okay. So one is this on garmenting margins. Another one is on the real estate side. So in the Address by GS, we have seen the collections of 204 crores against the total booking of 834 crores. So it is still just 25% only collections. So how do we see the collection in the coming period? Thirdly, in the real estate side, on the Q on Q, if we look at the numbers, there is a drop in the saleable area as well as number of units also. So is it because of the higher interest rate actually impacting the demand, or how do we look at going ahead in this particular aspect? And lastly, we have seen some news regarding ban on the new construction near Sanjay Gandhi National Park within the vicinity of 1 kilometer. So is it impacting us by any chance, and what is the status there?
Okay. So first question regarding garmenting, I will ask Sunil to respond, and the real estate, Harmon will respond as once Sunil responds.
Yeah, hi. Okay, on the garmenting business, if you see that one of the biggest pieces which are working in our favor, and I'll give you the context of margin there is, that as Amit mentioned, the China 1 Plus strategy is leading to a lot of global top players working on us, coming out to us and working with us in future on the strategic basis. So we have been able to, in the last 1 year, get into very strong alignments with some of the top global brands. Now, as a result, what happens, it is a business which has got a highly skilled labor force, and to meet the global quality standards, you have to make sure that you have A, capacity expansion in terms of manpower, and B, you have to train them well. So what you end up doing is you end up recruiting manpower cycle around 6 months in advance of while the lines are being put. So in the light of this strong demand that we are seeing with strategic tie-ups happening with global brands, we are ramping up manpower so that we can get them trained and make them fully skilled before they really start working on these high quality lines. And that is one of the reasons why you're seeing actually a correction in the margin, but actually this is something which is an investment of the future. In fact, we're very happy to see this happen, because what this does is, this helps us get into a space where we can go and pitch for even better, stronger alignments. So I think that's the only piece, and this actually should be treated as an investment which is happening currently in our business.
Okay, so that present workforce addition as well as present our capacity on the garmenting side, what kind of the business growth we can see over the next 2-3 years, or do we need also to do some investment? Is there any mindset you have that you have to do some investment on the garmenting side in the next 1 or 2 years?
So look, if you can see just the demonstrated performance compared to last year, we have demonstrated a 25% growth in the revenue already. And we see very clear plan to grow this business. As we get more and more opportunity, India is becoming a large textile export destination as people want to move out of China, diversify their supply chain. So we are fully there. We are taking the facilities in order to cater to the needs for whatever demand it comes. And therefore, we are training our people, we are adding lines, and we continue to grow this business. We see there is a great opportunity for us in terms of taking it to a very different level. And as I mentioned, operating leverage will help us in improving the margins as well.
Okay. No, so any plans for expansion also in this garmenting side in the foreseeable future?
Yeah, very clearly. So what is happening is that we have, in fact, one of the biggest successful pieces for us in this business has been, we have increased orders from our existing customers, but we have also built a very strong pipeline of new global customers. So yes, the way we see it, we are evaluating a very strong, expansion, which will happen over the coming years in terms of meeting this increased tie-up that we're doing strategic customers. So we are working towards that.
Just to give you perspective, we don't need a significant amount of capex. There's a small capex which we do, and depending upon and the time taken to implement that capex is also not very large. So when we get a customer, by the time the order starts to be executed, we will be able to install the line. But clearly, we have a big plans in this to take this business forward.
Okay, helpful.
And on the real estate, I will ask Harmohan to respond. Harmohan.
Yeah. Hi. So there are 3 questions that you asked on real estate.
Yeah.
So I will answer the last one first, which is the Sanjay Gandhi National Park. There is no impact as far as we are concerned on that. And in any case, Supreme Court has already clarified for Bombay that 1 kilometer distance does not exist, so it does not have an impact on anyone as of now. So that has already been clarified by the Supreme Court.
Okay.
In any case, we are not in the vicinity of that, so it will not have an impact even if it was there. The second question was relating to interest rate impact on the demand. As far as we are concerned, we are not seeing any impact on the demand owing to interest rate increase, because as far as Indian consumer is concerned, anything less than 10% is still considered cheap for home loans, because people have seen very high interest rates in the past as far as home loans are concerned. And a profile of both our projects, if we see in 10x, only about 60% people have taken home loans, and in addressed by GS, barely 10 to 15% have taken home loans, and the rest of it is all through equity. So going forward also, we don't see any significant impact on our demand as far as interest rates are concerned. And your third question was relating to cash flows of addressed by GS. You collected only 200 crores against a sale value of approximately 850 crores. So all these sales are on construction-linked payment plan basis. As you're aware, I mean, that's a normal practice in the industry. And as the construction progress goes on, the collection will happen. We barely come out of ground as far as addressed by GS is concerned. We are just doing the parking levels, and we've just come out of the basement level. So it's a very healthy and strong collection that we've got already of 200 crores, which is approximately almost 30% of the total sale value we already have collected. So as the construction progresses, the balance will be collected over the next 2 to 3 years.
Helpful. This last one on the branded apparel side, last quarter there was some write-off of about 98 crores. So for this quarter, this high growth is a reason of this backfilling of this destocking, or this is a sustainable number going ahead also in that branded apparel side?
There was no write-off of 98 crores in the last quarter. And it is a growth in the business. And if you see, we have been consistently growing for the last 4 quarters, building up the apparel business. So there is nothing of kind of a write-off or anything of that nature in the last quarter. Hello?
Mr. Ritesh, will that be all?
Yeah, that's all. Thank you.
Thank you. We have the next question on the line of Sachin Kasera from Swan Investments. Please go ahead.
Yeah, good afternoon and congrats on numbers. 2 questions. One was on the debt. You mentioned that because of the season, there's a lot of inventory and receivable gone up. So can you give us a sense, X of the IPO proceeds, what type of debt reductions we can see in H2 of FY23?
So look, we are not going to give a specific guidance in terms of the number, what it would be. But as the nature, and we have the demonstrated performance, that first half is the build phase for the working capital, and in the second half, people sell our dealer network, franchisee network, sell the inventory, and pay us the receivables which get created on the second quarter, and the first quarter is the inventory. So that is what we are going to see. As far as the IPO proceeds are concerned, we have clearly outlined that whatever the IPO proceeds happens, it goes directly further debt reduction. However, when we talk about in the next 3 years, we will be a net debt-free company, it is based on the strength of the significant cash flow being generated by the businesses. Because we don't have a large capex cycle to run, so all the cash flow generation and the working capital management will go towards debt reduction, which has been clearly shown. If I look at in the last 8 quarters, we have reduced the debt by over 800 crores on net debt basis.
Sure. But end of the year, on a full year basis, do you see the working capital for the current financial year being lower than last financial year?
So what happens is it will not be lower than the last year. However, what will happen is that the EBITDA generation will support the funding for the working capital, and the free cash flow generated thereafter would be used towards debt repayment.
My question was more in terms of number of days and not the absolute number.
The number of days, so if you see, we have already reduced from June to September, and we see further reduction going to be there by March.
Sure. A second question was, you have mentioned that you got some very good inroads and good order booking on the garmenting side. So if you could give us some sense what type of order book increase we have seen, and what type traction that we could see and utilization currently and the ramp up we could see going ahead.
So I think if you see, I'll take the question. So if you see what is happening for us right now as a result of this whole China Plus One strategy, I think one context I want to give is that we are right now built a very strong capability as a business unit in this garmenting business. There's a strategic realignment which is happening globally as a result of this, and people are looking for players who are vertically integrated and who can deliver very high quality garments. And we are one of the players which has got both these capabilities. So that is one context you have to keep in mind, and that gives us a huge headroom to go for the vacant space which is coming across as a part of this China Plus One strategy. Some of the customers which I can share in terms of a couple of indicative names which have come to us, and we are into very strong closures with them is, for example, some of the leading global players would be there. So that is something which you'll have to keep in mind. Some of those names I may not be able to tell you right now.
No, but I'm not asking for specific numbers, but can you give us some sort of indication, like if your order booking, if you could share the number of the order booking, or if you could share.
I won't do the order booking, but if you see, we have delivered a 25% growth right now. And I think we are very confident of delivering such kind of strong, healthy double-digit growth going forward also. We have pretty strong confidence, and as it was mentioned in the call also, we have clear visibility over the next 2 quarters, but we also believe that we can keep this momentum going.
No, I was saying if you could at least share, if your order booking was say 100 rupees in March or last year September, what is it today? So what is the percentage increase in order booking, if you not a specific order booking number per se?
Yeah, it is in the range of 25%. We have increased the order book compared to the last period.
And what would be the utilization levels currently in the effect, in the sense how much of headroom do we have before we may have to do any more capex there?
So this is a constant process that we continue to invest into the lines. So we will have, by the time we get the order, as I mentioned, it is a question of 6 to 7 months when you start executing the order, and it is in this time frame we are able to install a new line. And so therefore we are not going to have a situation that our utilization or lack of equipment will prevent us to execute an order. And between both India and Ethiopia, we are at a utilization level of 80 to 85%.
And also maybe just one more thing I want to add here is that we have also got a very strong program of improving our productivity and efficiency, and that is also something which is coming in handy very much on a current capacity itself.
Sure. And my last question was on the real estate segment. The reported margins is around 25% EBITDA. So in this, how is the land cost is at historical value, which I believe would be very low, or is it the revalued cost of the land, and hence, because if the cost is at historical value, then the EBITDA margin should be significantly higher.
Yes, so the land is at historical value, and if you see the secular trend on the margins, it has been an upward trend over the last few quarters, and it is continuing to rise. As compared to last year also, we've improved it by 5 percentage points, and before that, I mean over the last year and a half, 2 years, we have actually doubled the margins from 13% to 25%. and you will see an upward trend, albeit it will be a marginal upward trend, but that's the kind of margins you will see.
And you please understand also, this is our first project which we have started to build. We have created a team of 200 people, and we have a large vision for the real estate business. As you know, we have signed one JDA project. Now we are not going to buy the land. We will invest and build the real estate business through the beyond Thane will be through a JDA project. So you need to build that infrastructure so that you can efficiently construct it. As you know, for us, the execution is the key and the sales velocity. And that is the reason why we are able to deliver 2 years ahead of RERA timeline.
That's understandable, sir, and commendable. But what I'm saying is that when we look at some of the other listed peers also, despite buying land at the current market value, their EBITDA margins are similar to what we report. And hence, and we know in Mumbai the land is the biggest cost. And hence this 25% margin looks to be quite low, because in our case the land cost is almost very, very negligible. And while I understand our overhead rent could be a little more because we right now are building a larger organization. But still optically seeing, and by the very common sense logic, this 25% margin looks quite low for the real estate segment.
See, every player has a different strategy that they are following. Now, we have our own strategy. We are focusing on growth as far as this business is concerned. And if you see, the spectrum of margin ranges between 20% and goes all the way up to 45-50%, depending on the player that you look at. And each one has its own strategy. Some of them are focusing only on margins and not a very high growth. Over the last 30-35 years also, they have not seen too much growth. If you look at our growth numbers, we have hit almost 1/3 of some of the large players you are referring to as high margin, but their growth has been pretty low. Their return on capital employed has been pretty low. I don't want to dwell too much on what competition is doing, but each one's strategy is different. If you buy into our strategy is more predicated on growth and a reasonable margin.
Okay, maybe I'll take it offline. Thank you.
Thank you. We have the next question on the line of Surya Narayan from Sunidhi Securities. Please go ahead.
Congratulations for a good set of numbers, Amit and your team. And my first question is towards the real estate division. So what I understand from the follow-up question of the previous person is that my understanding is correct. If let's say when the 10x habitats is more or less it is completely nearly booked, and more of revenues to flow from the address by GS, will the margin be rising from here onwards?
No. So let us first understand the way the accounting is done is based on percentage of completion method. So if you see, almost 2/3 of the project is sold, and in terms of the construction pace also almost, let's say, 50-55% has been constructed. So therefore you're recording the revenue based on the completion method. So you have still a lot of revenue to be booked on the 10x project itself. Second, on the address by GS, it has just started. Therefore, the revenue on this address by GS is always going to, as of now, it is lower. And going forward, as the construction takes place, you will get more and more recording of revenue. As far as profitability is concerned, obviously, in a 10x project, which is a 1 BHK, 2 BHK pricing, will be slightly different compared to a 3 and a 4 BHK project. And it is a premiumness. And at the end of the day, the construction cost, either you construct in a Nepean Sea Road or you construct in Thane, is broadly the same. It is the question is only about the pricing and the benefit and the margin which you get. Therefore, the Thane pricing, based on the Thane pricing, the margins are appropriate. We have done a detailed work on this basis.
So how much premium the GS is generally compared to 10x? Can you just give any ballpark figure, realization terms, realization per square foot?
So the margin difference between the two projects will be roughly in the range of 250 to 300 basis points.
Okay. And my second question is related to the number of square foot that is to be going to be launched in the second half. What is the plan in both the cases, in the 10x and GS, for this year and for the next year?
So in H2, the entire project of 10x will be in the market. So whatever is remaining will be launched. And as far as address is concerned, that also will be fully launched in H2.
See, look, the fundamental factor of the matter is that almost 2/3 of the total inventory has been sold, and each of the project has at least 3 to 4 years to go. So we are calibrating our inventory as well as our sales in order to maximize the realization. So therefore, we will watch the market very carefully, closely, to see at the point of time we release some units, we take a price increase in order to get that. So therefore, we will not be specifically giving you the number of units which we are planning to sell in the second half of the year. We are calibrating based on the number of units as well as the price increases which we take.
So since your question is more on growth, I think the growth will firstly come from our Bandra project. So we have another project coming up in Bandra in the second half, which will help us grow.
That is in JDA, sir?
Yeah.
That is a JDA, yes, that is a JDA.
So what kind of possibilities from there?
No, so as we said, now the JDA project we start once we have a decent amount of approvals, then only we start the project. Therefore, we are in the process of getting approvals, so it is difficult for us to say whether we start in 1 month, 2 months or 5 months. So therefore, when we get the approvals in place, we will announce that when we are starting that project.
And given the percentage completion method, the benefit of that will accrue only in the subsequent year. So you won't see any immediate impact of that in the numbers.
So what is the current status of the JDA of the Bandra?
So it's currently under planning and approval.
Okay. So when are you expecting it to start?
Sometime next year.
Okay. And regarding textile, just I wanted some clarification or elaboration regarding the ethnics business as to what is the total number of stores, EBOs or whatever we have launched so far in this year, and what is further to be launched in the subsequent period, and overall for the next year also, because this is the first year, so the next year what is the kind of strategy we are having, whether we will be having exclusive outlets or will be clubbing under the Raymond shop. So what is the color of that? And secondly, whether we will be manufacturing all those items or we will be outsourcing from different artisans across India. So what the competitors are doing. So what is the strategy, manufacturing strategy as well as sales strategy with regard to ethnic wear?
Yeah, okay. So I'll take this question. So let me answer your second question first in terms of the manufacturing sourcing strategy. So as you know, in the ethnics business, the product lines are very, very unique in terms of craftsmanship. You have a different kinds of segments like from sherwanis to bandgalas to kurtas, pajamas, and the smart ethnics. So hence, what we try to do is that we obviously try to use the best-in-class fabric from Raymond itself as much as possible in terms of ceremonial wear. But since it's a very craftsmanship work, the model would be primarily getting it made and sourced at different places through artisans, as you say. And we are building right now a very strong and very unique vendor base of different segments across the country. So that's a point in terms of our sourcing strategy. In terms of our expansion plans, we are pretty much on track to right now do 70 exclusive brand outlets this year, and that is the number that we are gunning for in ethnics. We already have reached 50% of that mark. We have 35 already right now, and as I speak right now, we have visibility of almost another 10 to 15 stores which are under various stages of fitment stroke renovation, fit outs right now. So I think that mark is very much clearly in sight, and that's our goal. We have launched recently very, very fresh collections which are very unique to the brand identity of ethnics, and I would like to really happily share that in the last 45 days or see as the festive season has begun in, we are seeing a very strong acceptance of our collections. So this is a business, as we know, is a very, very unique business. Raymond has one of the biggest rights to win, and we are all on track to really ramp up very strongly.
Okay. And regarding the export inquiries, just wanted to understand which part of the globe we are getting inquiries, whether it is related to US market or Europe market or anything. What is the traditionally we are present into, and whether new markets are opening up for ourselves?
What's happening to this business? One is there are obviously new markets opening up in parts like Australia, Europe as well. But I think one of the biggest themes which is playing out for us is the strategic alignments which are happening with the top global players who may be headquartered in one country, but the businesses that they are asking us to cater to are pan-globe businesses. So in that sense, it is not uniquely placed to one geography because these customers actually cover a large part of the world itself. So I think that's the theme which is playing out really for us, apart from some other geographies like Europe also opening up pretty actively for us.
And truly the diversification of supplier base, and that's the benefit which we are going to get. And we have seen that some of the people who have not come to India, they have come to India and have started to partner with us for the exclusive sort of supply of garments. And let us not forget that we are uniquely positioned that I start manufacturing the fabric, the tailoring and the garmenting and shipping it out. So to that extent, we have this unique advantage.
Okay. And so regarding the luxury fashion wear or the ethnic wear, so are we partnering with something like N7 platform of nitrogen platform? So what the industry is aligning to, where the significant traction elsewhere is being seen. So what is the digital strategy in that? Because people love to see shopping happening through digital mode. So what is the case in our?
So I think the question which you're asking is what is our e-commerce digital omni-channel strategy? Is that the question, if I get it right?
Not really. It is related to fashion retailers. There is a strategy with the, many companies are adopting the nitrogen platform, which I was just going through. So whether we are inquiring or we are going in that direction for the virtualization of the designing. I mean, before somebody can buy a place order, he wants to see virtual things. So
if I get your question right, I think what you're asking for is that there is obviously a bit of what the question which I asked you asking is a bit of a metaverse question where there's a lot of augmented reality and virtualization of design which is happening. I think that's the question.
Correct.
Right? So I think, to be very honest, I think that metaverse piece is a little earlier premature piece for us right now, because I think this as a theme also is a very premature piece, and we'll take it as things evolve going forward.
And lastly, sir, regarding the total in our textile as a group, so how much is the outsourcing component? Because if you combine everything, it is around 70 plus 72% to be precise. Last year ending, it was 76.5%. So out of that, how much is the total outsourcing component in our business?
So look, outsourcing. We have the manufacturing facilities right from, we used to call from the sheep's back to the man's back. So we have got the yarns, fabric manufacturing, finishing facilities for both suiting, shirting, garmenting. We are doing the tailoring and sending it out. It is only in the branded apparel segment where we get these shirts or the trousers or the suits stitched outside of Raymond, and that's the only place where we get the outsourcing. Rest, the uniqueness with us is that we have an integrated facility, everything we do in-house.
Okay. Thank you, Amit.
Thank you.
Okay. Thanks.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question from the line of Mehul, an individual investor. Please go ahead.
Hello, am I audible?
Yes, you are.
Yeah, thanks for the opportunity and congratulations on a good set of numbers. I've got a couple of questions. One is in quarter two, there's an exceptional item of 10 crores. So if you can explain this amount, that would be helpful.
Sure.
The second is regarding the JK file IPO. So we have been, saying since last 2 quarters that we are waiting for favorable market condition and all. Now, as far as domestic market is concerned, it is almost at, all-time high, and the primary market is flooding with a lot of IPOs these days. So I'm just wondering, what are we waiting?
Okay, good. So first of all, simple housekeeping question on the exceptional loss. So 3 things. Basically, if you look at it, we had in one of the LFS channel customers, there is an expected provisioning for a credit loss to the tune of 20 crores. At the same time, what has happened, there was a glass building at one of our office premises at Thane, which had got burned down, and we got a final settlement claim of 11 crores out of that. So it is a gain. And the third one is on the JK file. We had disposed of certain land and reduced certain number of people, so that offsetted between 5 and 5.5 crores. So that is a net 10 crore of exceptional loss which has been booked during the quarter. So that's one. And as far as JK Files IPO is concerned, first of all, when you talk about, I think the primary markets are still, the way we have been talking to our investment bankers, that it is still not that conducive. And the purpose of our IPO was not to say that it is bringing the money into the business for growing either at engineering business or at the Raymond Limited level. We have very clearly outlined the purpose of doing this IPO was to bring the money and deleverage the balance sheet and make a debt-free company. So we are not in that hurry, so to speak, that I have to do and desperately I have to do it today to tomorrow. What we have the card available is till February. We are talking to our investment bankers and watching the market very, very closely, and at an appropriate time we will do that IPO.
Okay, but the proceeds will be used to, repay the debt. So earlier we had the market will reduce the cost on interest repayment.
Yeah, that is true, and that is why this was planned. So in February, when we got the card, immediately the Russia-Ukraine war started, and you all know then what all happened. So that is why we are in very close contact with our investment bankers to see that how and when can we really launch this issue.
All right, good. That's all. Thanks a lot.
Thank you.
Thank you. I would now like to hand it over to the management for closing comments.
Thank you very much, everyone, and look forward talking to you in the next quarter's earning release.
Thank you. On behalf of Antique Stock Broking Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.